All right, so let's continue. So I was saying that, I was trying to highlight, uh, sorry for that. I was trying to highlight a scenario that the maximum risk for minimum profit is obviously not you managing the risks of your account. Okay. Because in that scenario, your risk is higher than your reward. So, unlike in the better scenario where I was saying 1:3, yeah, you are seeing a scenario of 2:1 or 3:1. So, you see someone with an account size of $100, the person is ready to lose the $100 to make $50. Right. So, looking at it in the long run. So, imagine that this person has $100 account and this person wants to use 0.01, which is lowest lot size, and the person had 7 trades that were bad. What do you think will happen? The person would have lost how many dollars? $70. The person would have lost $70, and then the person had 3 trades that were good. Okay. Sorry, I said 2:1, right? Okay. So I said 2:1. So is that what I said? Let me be sure. Is that what I said? Risk reward ratio of 2:1, where you have maximum risk for minimum profit. I guess that's what I said. So, someone replying. Okay. So in that scenario, you are seeing the person risking in it. Okay. So let me explain it this way so that you grab. I just remembered something, and if I don't explain it, you confuse it. So the risk to reward ratio here is 2:1. So the person is risking 2 to get 1. Meaning, remember that we are taking 10 trades, and for 1 trade, you are risking $10. But here, the person is ready to risk $20 to get 10. The person is ready to risk $20 to get 10. Now, if the person had 7 trades that were bad, you don't even need to have 7 trades that are bad. Your account is already crashed, because 7 trades that are bad means you lost $140 and your account size is 100. So you are going home already, right? The person does not become profitable in the long run. So the person does not become profitable in the long run trading with that kind of ideology, right? Now let's reduce it. Let's say the person took 3 trades that were bad and 7 trades that were good. Now 3 trades that were bad meant that with the maximum risk for minimum profit, remember the person is risking 2:1. It means the person, for every $10 the person wants to make, the person is risking $20. Now you took 3 trades that were bad. So for every 1 trade, you are risking $20. You're not risking 10. Remember, it's 2:1. For the second trade that was bad, you risked $40. For the third trade that went bad, you risked $60. And you are risking all of these, you are risking $60 to get $30. So if your account size is $100 and you have risked $60, you have lost $60. That is, you lost 3 trades. $60. How much is remaining in your account balance? 40. right? $40 is remaining. So you discover that you're already on a loss, right? So even if the person makes 7 trades, like it can't even work, because in making 7 trades, it means you made $70, but then you lost $60 in making $70. Now, if you minus your gains of $70 for your loss of $60, what do you have? $10. It's obvious that that person is not profitable. I mean, from $100 and now in the $10, it's obvious you're not profitable. So that is for a maximum risk for a minimum profit. Then when you now begin to cite the case of maximum risk for maximum profits, I mean, that's a 1-to-1, right? You're ready to take $100 risk to get $100. Now, I did all of this with the view of the position sizing of the lowest lot size, using the lowest lot size 0.01, right? If I move the position size to the medium lot size of 0.1, obviously the principle still stands, but then the risk is still there, or rather the risk is more. Okay, so if I move it now to 0.1, it means for that $100 account, remember when we're using 0.01 lowest lot size, for that $100 account, you needed to have 1,000 pips against you to crash a $100 account. But the moment you increase your lot size to 0.1, it means $100 pip movement against you, you have lost $100. Are we together? So if you now decide that you want to take 10 trades, that your 10 trades has to have a maximum of 10 pips stop loss, 10 pips per 10 trade, because 10 pips times 10 trades is 100. So you discover the moment you increase your lot size, your risk also increases. Okay, so if I go to the standard lot size of 1.0 and the account size is $100, you just need 10 pips against you and you are gone, right? So your risk to reward ratio is very important. And then one other thing I need to add again for position sizing is this. Whenever you place a trade, don't always forget that your position, your lots are accumulating. They are cumulative in number. What do I mean? Let's assume that your account size is $100 and you take a trade using 0.1 lot size. Remember, if you're using a 0.1 lot size, what it means is that 100 pips against you, your account will crash. So let's say you place one trade using 0.1. It means on that one trade that is running, if that one trade goes against you, goes in a different direction, 100 pips, your account has crashed. The moment you open another trade using that same 0.1, it is no longer 100 pips to go against you for that first trade. It is now 50 pips, because you have introduced another lot size. You have added another position. So your first position that was 0.1 and that will require 100 pips for your $100 account to crash, meant you add another 0.1. The first one will not require 100 pips to crash you. It will require 50. The new one you have placed will require 50. So if both of them cumulatively give you 100 pips against you, you have crashed. Are we together? I hope the anointing of this class is reaching everybody.
Sir, please, can you explain this last part just finishing? Can you just explain it again? Because my network was...
Okay. So I'm trying to explain risk management with position sizing in view. And I said that the moment you add or place a trade, don't forget that your position size, the number of trades you place, right, is cumulative. What do I mean? I mean that let's assume your account size is $100, okay, and you are using the medium lot size of 0.1. Remember when I was calculating the number of pips, right, attached to using 0.1, I said 100 pips using, I said 1 pip is $1 using 0.1, right? So 100 pips is $100 using 0.1. So 100 steps in your favor is $100 using 0.1. 1 step in your favor is $1 using 0.1. Okay, 1,000 steps in your favor is $1,000 using 0.1. The moment you place one trade using 0.1, it is already, you already have in mind that supposing you're not putting a stop loss on that trade needs to go 100 pips or 100 steps in the opposite direction, and your account will crash using 0.1. If you add another trade again, let's say the first trade you were trading gold, you're not going to see one opportunity in GBP USD, you're not going to add 0.1 again. Your account, the first trade will not require any more 100 pips against you to crash it. It will reduce to 50 pips because you have added another position using 0.1. So the 100 pips that are supposed to crash your account will now be divided by those 2 trades. So one of those trades, you just need to see 50 pips against you. The new one you have added 50 pips against you. Cumulatively, 100 pips, your account has done what? Crash. Do you understand now? So you see, your position sizing are cumulative in order for you to be sustained in the market. Does that explain if what I was trying to say?
No.
Do you understand now?
Yes, sir.
All right. So I need to drop with us a mathematical formula to calculate your lot sizing based on your account size or based on your deposit. Now, you might not even need this formula because I don't even need it. I just know what I need to know because I've already explained it before. But in order for you to write it down, the formula is 0.1 divided by 100 times your margin deposit. I come again. To calculate your lot size is equals to 0.01. I think I said 0.1 in the first zero. That was wrong. So to calculate your lot size, the formula is 0.01 divided by 100 times your margin deposit. So if your margin deposit, if the amount of money you are depositing, your capital you are depositing is $1,000, right? And you do the math very well, you have a 0.1 lot. Now, that 0.1 lot means that, remember that 0.1 is medium lot size. It means that for 1 pip in your favor, you're going to make $1. For 100 pips in your favor, you're going to make $100. So for an account size of $1,000, to crash that account size, you need 1,000 pips against you. Now, as much as this formula is here for you to calculate your lot size, I'm not also suggesting to you that having a $1,000 account, you should use a 0.1. In my own opinion, having a $1,000 account, If you're using 0.01, 0.02, 0.03, 0.04, 0.05, right? But then if you are going to maintain using 0.1, I'm going to save something fresh now. If you are going to maintain using 0.1, it is better that you don't place that 0.1 immediately. You may start with 0.02 and then you watch the market. And then probably the market is going against you. But then, I mean, obviously we should know that our analysis are not 100% sure, right? Different things can happen to it. But let's say all the confluences, all the data you need suggests that the pair should go in your favor. But then it is going against you. And you didn't start with 0.1. You place the trade using 0.02. It means if in your mind, in your risk management, you have apportioned, you have detailed down in your trading plan that for one trade, you are going to risk 0.1. It means if you place that first trade using 0.02, you still have about 0.08 available to you to add as more positions, which will sum up to 0.1. So you place a trade and it's 0.02 and it's not going in your direction, but you're still sure that it's supposed to go in your direction. You can add another one again. Let's say 0.02 again. Now that cumulatively means 0.04. Can add another one again. Let's say 0.05. That cumulatively means 0.09. If you add another one of 0.01, it makes it 0.1. So you have already gotten to your maximum risk or the maximum lot size you have determined your trading plan and discipline to use. So with this example I just cited, let me bring it now. Let me expand it more. Now, your account size is $1,000, right? And your lot size is 0.1. It means to crash your account, you need 1,000 pips against you. Now, if your risk management plan is that you are going to trade 10 trades, it means that each of these 10 trades needs to go 100 pips against you for your account to crash. Now, you want to place your first trade. And instead of using 0.1, you started by using 0.01. It means you still have to spare 0.01 in 9 more places in order to cumulatively get up to 0.1. So you place the trade using 0.01, which is lowest lot size. But in your trading plan and your discipline, for every trade you are going to take, you plan to use 0.1, which means the maximum stop loss for that trade is 100 pips. But then you place the trade using a 0.01. It means you still have 0.01 in 9 places for it to sum up to 0.1. So most times you do that with the view, because you have a view that probably the market might stretch a bit, right? It might not immediately go in your favor a bit. So you might just use that 0.01 to test the waters. Now, obviously, for you to do this, right, you need to have a certain level of knowledge yet. But I'm just assuming that you guys are good already, right? I'm just assuming, right? Obviously, I should not be telling you should use 0.01 to test the waters. Like, okay, don't test anything. Enter when you are sure, right? But then let's assume you want to test the waters, and then you just test it with 0.01. Meanwhile, you still have 0.01 in 9 more places to keep on testing the waters to get up to your necessary risks or lot size. So probably the trade is going against you. You can begin to probably still add more positions, 0.01 again or 0.02. But the moment the summation is 0.1, you should not add again, because the moment you add, you are already beginning to enter into the number of trades you said you are going to trade. So let's say you said you're going to take 10 trades, and you said 1 trade per day, and then you have gotten to 0.1 cumulatively. You now go and place another trade again with 0.02. You are started eating into the lot size that you're supposed to use for tomorrow. Okay, so all of this is necessary to manage risks. All of this is very necessary to manage risks. So you discover that using your lot size or positioning your lot size is very critical to survive in the forex market. Hallelujah.
Amen.
I talked about compounding at some point. Okay, so this is an example of compounding. Can you see my PDF? Can you see it?
No, sir, it's the chart we are seeing.
Okay,
No,
the chart
sir.
you are seeing. Okay, if you are not seeing it, let me explain what is in the PDF to you. So draw a table. Draw a table, and that table will have 4 rows, 6 columns. Draw a table quickly. I want to explain compounding now. That table will have 4 rows, 6 columns. I hope you know. When I mean rows, I mean on the vertical axis, right? Column, I mean on the horizontal axis. Okay. So now on the first row, the heading for that first row is trade. The heading for the first row is trade, and then number that row progressively, number 1 to 5. So after the heading trade, the next thing should be number 1, down number 2, subsequently like that, 3, 4, 5. The second row, the heading for the second row is position size. The heading for the second row is position size. Now, number that position size for trade 1, number it down using 0.1. So for trade 1, 0.1, trade 2, 0.1, trade 3, 0.1, trade 4, 0.1, trade 5, 0.1. Are we following? Are we following?
So after position size is what?
I've not said it now. I said the first rule is trade. That's the heading. The second one is position size. Now, filling position size downward, fill it to 0.1 till number 5, from number 1 to number 5. Now, the third rule, the heading for the third rule is equivalent profit in 50 pip trade. Or you can say, yeah, I will not use the word. I would have said profit in 50 pip trade, but then equivalent is very important. Equivalent profit in 50 pip trade. You can abbreviate your equivalent, right? So the heading for the third rule is equivalent profit in 50 pip trade. Now, under it, you are going to put $50 down. For trade 1, $50, trade 2, $50, trade 3, $50, trade 4, $50, trade 5, $50. Equivalent profit in a 50 pip trade. Now, for the fourth rule, the heading is current balance. The heading is current balance. Now, for the first trade, the current balance should be $1,050. Trade 1, current balance $1,050. Trade 2, current balance $1,100. Trade 3, current balance $1,150. Trade 4, current balance $1,200. Then trade 5, current balance $1,250. Now, I'm trying to explain trade compounding technique to you with the assumption that the initial balance of your account size is $1,000 and you are trading with a risk to reward ratio of 1:2. So you are using a risk. Yes. Ezekiel, what are you saying? Are you talking to us, Ezekiel? You are not audible, please.
No.
Okay. Please mute yourself, right? Thank you. Now, I'm trying to explain compounding. In compounding, using what I've just told you, these are the assumptions that your capital is $1,000 and that your risk to reward ratio is 1:2, which means if your equivalent profit in a 50 pip trade is $50, it means your target was to just see 50 pips. The moment you get 50 pips, you get $50. Using a risk to reward ratio of 1:2, what is your risk? If $50 is your profit, using 0.1 and you need 50 pips, what do you think was the risk for that trade? With a risk to reward ratio of 1:2. Somebody talk to me.
Just come again with the question.
Sir, come again. Even with the explanation again for it, please.
Did you write the table? Let me be sure that did you fill in your table?
Yes, sir. Yes,
Okay.
sir.
Now, this is my question. Under the column, under the row 3, I said the heading is equivalent profit in 50 pip trade. So it's assumed that the trader of this account is looking for only 50 pips. And that means using a 0.1, the trader is looking for $50 because using 0.1, 1 pip is $1. So 50 pips is $50. And then we're also assuming that the risk to reward ratio is 1:2. So if this trader's profit is $50, what was his risk?
$25.
$25. So when the trader places one trade using 0.1, he has arranged or set his stop loss to be 25 pips away from his entry in the opposite direction and 50 pips away from his entry in the desired direction. Let me explain that with my chart. We have about 8 minutes. So now I'm looking at US oil, right? And where this white line is, where my mouse is your entry position. Using my crosshair tool, if I take it here and I bring it down, with where my mouse is, this is already 135 pips. Remember, when I was teaching you guys this, I said, look at the middle figures. When you look at the middle figures, do not take cognizance of the last digit, which is right here, 6, because that is in fractional place. You take cognizance of 135. Now, 135 here already indicates 135 pips. And I mean, that's not a small, that's a very small movement from where I took my entry. So I'm going to take it up a bit to get 35, 25. Oh, this is probably the closest you can get. So you can see how small this is. But then let me go to another pair. Let me use gold. I think gold will make sense now. Gold. So where this white line is the current market price. Like market opens now. Are we going to be learning till market opens? Yeah, probably market open. Which session is open now? CD is already open now. Yeah, ceiling is already open now, right? So, but by level you observe. I mean, New York, sorry, clinic on Asian will open. So where this white line is the current market price, right? Now, let me tell you what, if I put my mouse here and I go up, what is reading here? 26 pips. If I go up again, what is reading here? 45 pips. If I go up again, 53. So from this white line to where the cursor of my mouse is, if price moves that distance, it is 53 pips. Now, if I go take it down, currently now it's 45 pips. So if price moves a downward distance, getting to where the cursor of my mouse is, price will move 45 pips. So let's say the person who placed that trade wants to buy, is placing a buy trade. It means the trader will have to set a stop loss of 25 pips. Now, this is 25 pips. I take it down, this is 21, take it down, 30, take it up, back, 27, 24, 27, 24. Now, what is the price for 24 pips? The price for gold with a 24 pips movement downward right here is 1,704.65. Do we agree? Remember,
Yes.
I was explaining this, all right? So 24 pips downwards, the price for gold is 1,704.65. So when you're typing in your stop loss on your MT4, if your stop loss is 24 pips stop loss, you will not put 24 pips. You will put 1,704.65 as your stop loss. Remember, the person we talked about used the stop loss of 25 pips because he had a risk to reward ratio of 1:2. So I'm just citing this as an example. Now, remember that the person is placing a buy trade. So if I go up, that should be in the favor of that trade. Now, the upward movement, I need to see 50. Now, I'm going up. This is 49. This is very close, right? So if price moves 50 pips in the forward or upward direction, because I'm placing a buy trade, the person will make $50 using 0.1. Now, in the take profit column, the person is not going to type 50 pips. There are softwares too that allows you to type, place in your data, your take profit, your stop loss, and all of that based on the pips. But right now, that will complicate you if I'm going to add that to your teaching. But what you need to know is that what the person will type in as a take profit price is 1,712.01. The moment price gets to 1,712.01, the market will take you out in profit. If the market goes in the inverse direction of, I think it was 1,704, right? Points, I think 65 or so. If the market goes in the inverse direction, it will hit your stop loss and take you out. So you can imagine the size of candlestick that this person has in view. But don't forget that this is 4 hours time frame, right? If I take it to 15 minutes, right? This is 15 minutes. If I show you what 50 pips looks like in a 15 minutes time frame, it will be bigger than what it was in the 4 hours. Now let me show you. I'm here and I'm going up. 14, 41, 44, 47, 51. I see in the 4 hours time frame was very small, right? Because you are looking at a higher time frame. But if you are taking your entry, I mean, if you are using a 15 minutes time frame, you see that you need a candlestick to actually give you this movement from here to like here to be sure you have 50. and then a candle movement in the opposite direction, like here, and then you have lost, right? So you discover that, what was I trying to explain in the first place? Yes, I was trying to explain the compounding thing. Oh, we have less than 1 minute. So you discover that using a risk to reward ratio of 1:2, with a profit of $50, the person risked $25 per trade. Now, I told you number 1 to 5. That means the person take how many trades? 5 trades. And the person risked $25 per trade. So if those 5 trades were to go against him, the person would have lost how many dollars? 100 and what? $25, right? $125. 25 times 5 is 125, huh? Right?
Yes, sir.
Okay.
Yes, sir.
Zoom will take us out again in less than 1 minute. I'll share the link. Please join in. Before we were 9 or 10. Now you're now 6. Let me not see 2 people. All right. I'll end the class now and then we'll continue. Please don't be lost. I told you it's risk management class. So your brain, I need the sharpness in your brain. Thank you.